helping you to weather good and bad economies without putting retirement on hold. This is the Tumolo Financial Podcast with Ken and Nick Tumolo. Ken and his son Nick know that creating a comprehensive financial plan can align your hard-earned life savings with your retirement goals. Consider them your retirement architects. Now, the Tumolo Financial Podcast with Ken and Nick Tumolo.
Everyone talks about Roths, and a big thing that shows up, especially when you're scrolling through Facebook these days, is the Backdoor Roth. And they're basically saying it's this great strategy that you should be doing. But when you start to dig in, it might not be the right strategy for you. A few things to know as it stands right now in 2026, if you're 50 and older, you can only contribute $8,600 into catch-up. And so for a lot of the high income earners, it's always trying to find some kind of tax strategy. So all of a sudden this Backdoor Roth comes up, and it is a little tricky. You're actually doing a contribution into your traditional IRA, and you can actually do a pretty big contribution in there. But then later on, you're converting it to Roth. So you're actually really doing a Roth conversion in the same year that you do a contribution. So mistakes can be made. I just want to point that out. And I'm going to point out a few of those mistakes today. And one thing I will say, if you need help, seek help. I run into them all the time. So one, the number one big mistake, not understanding the pro-rata rule. And so let's pretend we're sitting in 2026, we'll use, and you put money into that traditional IRA. And let's say you put in $20,000, but then you went to do a conversion and you didn't convert all of the money that you put into that traditional IRA, and you're a high earner. The money left in there is now taxable money. And you'd say, well, how's that a problem? The problem comes up when you get into retirement, because when you start to take money out of that traditional IRA, you have to take out money proportional. So it makes a mess. So big thing to note is if you're going to do this Backdoor Roth, make sure you follow the steps and make sure you do everything correctly. Otherwise, you might make your retirement draw a little bit messy when that time comes. Forgetting the December 31st rule. And this kind of ties into the first mistake that I'm talking about too. You contributed money in, let's say 2026, and then you think that you can actually convert the money in 2027. So you're doing your Roth conversion at that point. Guess what? That money that's in 2026, because you didn't convert it in 2026, now it forces you into that pro-rata rule. And so now you're back to mistake number one. Because mistake number two, you just didn't do it when you were supposed to. So when we talk about timing this thing and timing correctly, these are the things you have to be aware of. And I can't tell you how many times people have come in and I find out they have after-tax money in a traditional IRA. It's just because, and it's because they're trying to run some strategy that they thought that they could, and they just didn't seek help. They didn't ask their accountant. They didn't ask an advisor. Seek help. I mean, it's get it right. And I know some of this stuff is complicated. Thinking a Backdoor Roth is automatically tax-free is another mistake. Years ago, we had someone come in and they're like, I did a Backdoor Roth. I didn't withhold any taxes. And now when I do my tax return, I owe a whole bunch of taxes. And when I say get it at that point, I'm like, it's too late. If I knew you back then, I could have told you, hey, make sure you withhold taxes. Make sure you carve out taxes on the side. And then where are you taking the taxes from? Are you taking it from the IRA when you convert, which causes a whole nother set of issues? Or are you taking that tax money out of your bank account and paying an estimated payment to the IRS in the state of Connecticut? So it really comes down to knowing the tax effect. Mistake number 4, waiting too long to convert. Sometimes when we're doing Backdoor Roths, and I'm going to say more of when we get older, sometimes doing those conversions when we're 59, 60, 61, they're our highest income earning years. And sometimes the math doesn't work. You got to do that backdoor Roth, and you start to math it out over time, and you don't make up for that conversion. So the thing is you want to make sure that math works. It's got to give you some type of advantage. One more thing I'm going to tell you about mistake number 5, forgetting to file a Form 8606. For those of you that make a mistake, that first mistake that I talked about, where you left money inside the traditional IRA and you didn't convert it, and now you've got that pro-rata rule mess where you have to drop proportionally later, you actually have to report every single year when you file your taxes on this Form 8606 that you have taxable money inside of your IRA. And then what happens is if you do it again, you got to add on top of that. Big reason why is how are they going to know you actually had taxable money sitting there? And if you don't do this, guess what? When you draw, you're going to pay tax on that money again. So you actually pay taxes on that money twice because you didn't do things properly. And who wants to be taxed on their money twice? I don't want to be. So big things. When you do these backdoor Roth strategies, and like I said earlier, you see them all over the internet nowadays. Advisors are putting them up. People that aren't even advisors are doing these little Facebook and YouTube things. You really got to know the rules. You don't want to make a mistake. You don't want a tax mess when you get into retirement. So if you need help understanding whether or not doing a backdoor Roth is right for you, you can just click on the link below or visit us on tfcheckup.com.
Investment advice offered through Tumolo Wealth Management, an SEC-registered investment advisor. Content contained herein should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product. Please consult with a qualified financial, tax, accounting, or legal professional before implementing any ideas or strategies discussed here.